All right, so cool. Tax strategy masterclass here. And yeah, I'm going to probably just blow through some of these as I see fit in here. This is technically actually my master deck. Everything's in here. All the juice is in here, but I just hit a whole bunch of stuff too. But yeah, we'll tailor it. Just quick in the chat, I know we know Austin is a real estate professional, but anyone else, if you just want to drop in the chat, like if you want to comment W2, if you're W2, comment REP if you're a real estate professional, and then biz if you're a business owner, then maybe I can tailor it a little bit more towards you. And then we can or mix it all up. So we got Coco W2, Leela W2, Mike W2 small biz. Anyone needs coaching services? New year, new you. Mike's Guys Biz. That's a small business. Just heads up, everyone. And then Katrina, we got W2. Leland's husband, W2. Michelle, your biz. Annie, W2. Social media influencer. Hey, you just got to put yourself out there, guys. I don't know what I'm doing. I just post and pray. Nick, W2, small biz, small biz. Oh, okay. Actually, a good chunk of small businesses in here. All right, cool. So we got the hodgepodge, but we'll also stay on brand and stay on theme of what we talked about, but we'll dive into it a little bit more. So, all right, first part, who the CPA dude is. If anyone doesn't know me, my name's Tony Hong, own the CPA dude. We're a tax filing strategy firm, serving clients across all 50 states. Usually Annie always tells me to do these type of items and get myself out there versus just staying in the beauty of my home. And then also dragging me to events. But yeah, we help you save money on taxes. And our big thing is to not have you overpay like what my parents did. Big part here, I always say our favorite friend here, if you fail to plan, you plan to fail. Good old Ben Franklin on $100 bill. Same goes for your taxes. I always say if you don't build a house without a blueprint, you don't work out without a workout plan. Why are you filing taxes without a tax plan? So all goes the same there for you. And what does tax planning actually look like? It's not reserved for the rich. It's reserved for anyone that pays taxes. So aka everyone if you're working. But these are the few components that can be what actually tax planning looks like. You don't have to do everything here that I have on the slide, but do think about how these can affect you. And how you really do tax planning is you take bits and pieces of this and you go ahead and pull them out at the right time. I say these are tools in the toolbox that you can use to save money. So not all the time you 1031 exchange is your go-to strategy, right? It's not the go-to strategy all the time, right? There's many other strategies you can do. So big part is, how I really learned this. I took the CPA test and, my parents assumed that I was like, hey, you can save money on taxes now. I'm like, no, like they don't teach you anything taking the CPA test. And then also when I worked at KPMG, one of the big four companies, all they teach you is how to file taxes. They don't actually how to teach you on tax strategy. So that, went down the YouTube university route, read some books, and kind of pieced it together. None of the books actually tactically tell you how to do anything. So what you got to do is just practice on yourself, practice on your parents taxes, because those are the people that want to save money on taxes. So if your family's money's on the line, you're probably gonna care the most. So really just figuring out how we can save for the family. They had a business, they own real estate. And then that's, how can we best save them? And then some strategies were unraveled along the way. So I'm going to go over a couple sections and how it can affect you here. The big part, first section is your entity structure. So for W2 folks and small business folks, since we have a lot here, we can start with it. And your entity structure, think about it as your tax foundation. If you don't have a good foundation and you keep on building upon it, it's going to crumble over time. So you want to make sure you have something amazing in place. Otherwise, like you build like a 20-foot tower or 20 level tower, it's going to all collapse. So the big first one for all the small business owners and the easiest one here, and also for the W2 people, is to become a sole proprietor. And being a sole proprietor is super easy. You literally just can hold yourself out as you can just call yourself Tony Hong, sole prop. That's it. No registrations with the state. The only registration you might have to do is with your city for a business license, but you can just literally become a sole proprietor tomorrow. It doesn't take much, and it's the easiest form to start getting deductions. Now, the big thing is you just can't become a sole proprietor and say, I'm going to have a basket weaving business. You actually have to have some type of income in order to have those right deductions. So all the small business owners here, this is probably how you started, unless you just hopped right into an LLC. But, for W-2 people, and why I wanted to bring it up tonight is that you can take whatever your skill set is today and then just start doing freelance work. And once you do freelance work, you're considered sole prop, and then you're going to enable yourself to be able to grab the deductions. So you can take your home office, you can take your cell phone, you can take your iCloud subscriptions, like your car deductions, all those things that you're paying for today, you can actually start to use. So that's why you want to have some type of side business if you are a W-2 person, because it allows you to actually start writing off and using the tax code. One example you can easily use is if you want to drive Uber, you can literally start deducting miles from your car. You can take some depreciation pro rata of how much you use it for business, but then you can also deduct your cell phone bill, right? Because you need the cell phone in order to navigate and pick up the people from Uber. So there's many creative ways that you can do this. Also, this can be your, I'm not going to call it passion project because hobbies aren't deductible. Yeah, it's going to be like the business that you always want to start in. This is a great way to get started in the first thing. And then that way, this is kind of like the path. And then it's kind of like a mini drug. Like once you kind of have that first taste of earning money outside of your W-2 and getting paid per hour, you're going to just like, oh my gosh, there's a better world out there. So sole prop is how you can start optimizing yourself if you're W-2. Just start some business, start take expenses that you're already paying today. Now, the next stage here is LLC. So if you want to really get more complicated with items, you can sign up for an LLC. An LLC, generally speaking, can be single member, multi-member, but this is when you can start to like up level yourself a little bit more and you have layers of protection. So if you get sued, everything in LLC, assuming you did everything correctly, you can limit your liability. However, it does not save you money on taxes. So LLCs, they're just literally there for legal protection, but in the future, you would be able to save with an LLC. So that's where people get confused about is like, does an LLC save me money on taxes? It doesn't. It just protects your assets. And then the other thing with LLCs is that you don't have to have it to start a business. So that's why in the prior slide, it was just you can become a sole proprietor and then you can get started right away. But LLCs are good because it provides you a medium to go into next stage. That next stage is to being an S corporation. So an S corporation, this doesn't actually, it's not a real legal entity. All it is just a tax election. And it's where you're just saying, hey, IRS, tax me like an S corporation. Now, why do you want to be taxed as an S corporation? Is because it saves you a ton on self-employment taxes. So that's your Medicare, Social Security taxes that you're able to save. So with an S corporation, if I use $100,000 example, if you're go back, if you're an LLC or a sole proprietor, if you're making $100,000, you're gonna have to pay $15,300 in self-employment taxes. Now, if I have the same $100,000, but I pay myself 50,000 bucks, and then I take the $50,000 as distributions, then only the $50,000 on the W-2 that I pay myself is subject to self-employment taxes. So now you have that 15,300 in half. So that's 7,650 that you're able to save. So S corporations, it's real good as you advance and get bigger for you. So that's kind of like entity structure. So like if you want to start up a side hustle, great. Sole prop's a great time. If you want to get a little bit more serious, LLC is excellent. And then from the next level is like S corporations. Now the downfalls of the S LLCs though, for our lovely folks in California, it's going to cost you $800 every single year. So that's the not so pretty sign, but also lawsuits are going to cost you much more than $800 in your lifetime. So just protect yourself. I do know that we always want to be very mindful of the fees that we do spend and invest in, but as your wealth grows, you want to start protecting it more and more. And then S corporations, this is where I would say 80% of small businesses get to, unless you want to be at a C corp, which I'll talk to in a second. But S corporations, generally speaking, you want to start weighing it out anywhere, if you're savvy, about 50-ish grand in net income. If you're like not as savvy, about $70,000 as net income of when you want to do it. So I always get that question, like, when do I become an S corp? Generally around those, I would say those income levels. LLCs, this is like how much protection you want. So if you're like I always tell our clients on a scale of 0 to 10, are you 0, going to church, no tolerance for risk? 10, you're like going to Vegas, you can gamble all day, like our good old friend Wei-Ming, always luring us to Vegas. And if you got the tolerance for risk, And like you don't want the protection, you probably don't need an LLC. If you're super like kind of scared, you probably want LLC. So always consult your, your legal advisor also. Like I'm just here to tell you about from the tax side. LLCs don't save you money on taxes, but LLCs allow you to elect as an S corporation, which will save you a ton in taxes. And then the last part of the entities before I wrap up this section, and then we can pause and take some questions, and I'll move on to the next section, is C corporations. So C corporations, this is actually good for people that like don't want to have what do you call it, a business related to them and want some like separation. Also, it's good for people that have a crap load of properties. Crap load of properties, I would say probably upwards of where you're collecting, let's say 300,000. Say you collect 300,000 rent, probably 500,000. So if you're collecting $500,000 in gross rent, you may want to stand up a C corporation as a management company. The reason why I'm like guessing 500,000 is because if you have $500,000 of gross rent, then you can charge yourself a management fee. Management fee is generally about 10% of the monthly rent. So that's about 50,000 bucks. 50,000 bucks, you can then reduce rental income by $50,000, be the own property manager. And then from there, you can also wash in expenses. So C Corps, like when I used to work at KPMG, we use them as blocker entities. Also, if you have like, I know we got some small businesses in here, you have, what do you call it? About $750,000. That's when a C Corp of net income makes more sense than an S corporation. So these are just the entities that I want to go over. And for people that were W-2, because I wanted to, bring some advice for the W-2 people, is starting a business. So the tax code, it's written in three ways. It's written number one for businesses, number two for charity, number three for real estate. And, being fair, we all know, well, real estate is one of the paths. So the other side that sometimes people forget about is the business side, and then also from a charity side. And the biggest thing too is like you want to be well-rounded in all three if possible. So you want to have a little bit of everything because it's going to reduce your tax bill versus just having one big concentration in one. Don't get me wrong, we got clients succeeding all day just in a heavy concentration of one, but a solid tax plan, like I said earlier, is made up of many components of structuring, retirement, real estate, business, charity, and then income shifting. So I'll pause there for the entity section, and then we can take some questions here. Where's the question thing here? Let's see, we're here. Okay. All right, question. Da, 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 da. All right, cool. Oh, nice. Swimming 1031 exchange bestie. Nice. Okay. Leela, what's considered revenue versus hobby? So the big thing is as long as you don't say it's personal and there's a real business against it, then it's gonna count. Once you say it's like, hey, it's just like a side, like a hobby, and like the IRS does not like that word. So like as long as your intent of starting the business is actually to generate revenue, then it will count. But if the intent is to, for example, but you can see it as two coins of the side. It's like my intent is to turn my Pokemon hobby into a write-off, not as good. Versus my intent is to have my Pokemon cards make me money so I can buy them. So there's two different ways of how you can spin it. Some people just buy Pokemon cards, collect them, it's cool. Some people will actually buy Pokemon cards in the hope of flipping them for profit. So as long as you're in for profit, that's what's going to count for you.
So I have a question about that. And this is not really for me, it's actually for one of my clients. She
Mhm.
started doing these really unique drawings. She's got a lot of followers now, and she's
Nice.
getting paid through affiliated marketing. But she's also going to sell this product in the form of coasters and other products. She's not generating that much revenue yet. And I was reading through the IRS website, and
Oh,
it did
nice.
say that you have to make a certain amount of money in order to take the business deductions. So she's
Mhm.
not taking any deductions right now in the first year. But it sounds like what you're saying is as long as she's intending to turn that hobby into a business, say last year, then she can take those deductions.
Oh yeah, exactly. As long as you're so what happens on an audit, so we have an IRS auditor on our team. So what they do is they'll
Okay.
actually look at what your intent is, what your business plan is, how are you actually going to get revenue. So say if in your example, your client actually listed all on, they just got a Shopify store, they had a business plan, they actually put the products out for sale, and then it
Yeah,
takes money to make those products. As long as the
right.
intent was there, it's kind of like let's just pretend if
Yeah.
we had a hot dog shop and like you stood up a whole
Okay.
hot dog shop, but unfortunately no customers came. You still get all the write-offs because you're out there trying to sell hot
Right.
dogs. But yeah, your client sounds like what Annie wants to become a social media influencer, get paid for affiliate marketing. So you could totally do that. That's a great medium and great proxy. My sister's very similar to that. She's an artist, and then she sells
Okay.
her art products, and then sometimes she gets brand deals. So it's all housed under her S corp. Is how we set her up.
Okay. That's
Yeah.
great because
hmm
she thought that she couldn't do it. But okay, thank you.
Oh yeah, great question. I like you're a student of the craft. Just dug into the tax guide. Dig it. Dig it. Nice.
I love
Yeah.
tax.
There we go. There you
Not paying
go.
it. I want to
Uh-huh.
learn
Yeah.
about tax so I don't have to pay it.
There you go, student. Yeah, I like it. I like it. We can be friends. Dig. All right, cool. All right, let's see what we got for questions here. Danny reselling tickets. Nice. Yeah, actually, I'm curious. He's reselling those Warrior tickets still. Quote, treat your business like a hobby. You'll be paid. Oh yeah, straight up, Jonathan. Yeah, literally, like if you whatever treat and how much intent you put behind it and how much like care you do, that's what the results are going to be. So if it's a side hustle, you're gonna see side hustle results, right? It's if it's your main hustle, then you're gonna see main hustle results. So I think the joke, what's some joke I saw on like the internet was like your 9 to 5 is the side hustle, is technically your side hustle, and then
Yeah.
your like 5 to 9 is actually your like real like that's your real job, like that's your main hustle. All right, cool. Threshold convert to S corp. Yeah, about 70,000 in California makes sense. You can get away with
Okay.
50,000 in other states. The only issue, the reason why it's lower in other states versus in California is because of the $800 fee. And then also once you're an S corp, you have to pay a 1.5%. So usually if you take 1.5% divided by 800 or the other way around, that
Mm.
comes out to 53,333, which means that you really won't break even until that point. So you'll see dramatic tax savings of about 70,000 bucks. But if you're like really like nifty, like if you know the tax code, like kind of like what you do, you can probably get away at about 50 grand.
Mm.
So
Yeah.
Tony, to confirm, this is Brian, and thanks for answering that. If we make over 70K, then we can consider S corp.
Oh yeah, 70K, I'd let it rip all day. Yeah, there's plenty of
But
tax
that's if we
because
like, I mean,
yeah.
obviously, that's if we, start doing the home office thing, commute and everything, right?
Oh yeah, so the S corp, yeah, like if since there's actually many small business owners in here, you would probably just let it rip from you have the S corp, and then if you got kids, pay the kids, got parents, pay the parents. Don't mess up their Social Security and Medicare, not the Medicare, their food stamps and their Section 8. Don't mess that one up. And then you got your Augusta rule. So you have all the non-cash expenses you want to use, and that's why S corps are good for that. And then also you can set up accountable plans too. So yeah, once you have an S corp, you can start to really optimize more, and you can save more on self-employment taxes too. Great questions.
Thanks.
Um, yeah, definitely. All right, Annie, what do y'all do for small business? Oh
Can
yeah,
I,
yeah. What are people's small
sorry, Tony,
businesses? Yeah.
can
Uh-huh.
I just ask a follow-up question on the S Corp? So,
Yeah. hmm
I'm also a licensed broker here in Colorado. I have an S Corp. That should be a good LLC or I guess selection, right? For as a real estate agent
Oh yeah, yeah.
to be in an
Uh-huh.
S
Yeah.
Corp. Okay.
Yeah. Oh, definitely. Oh, you're in Colorado? I thought you were in the Bay Area. Yeah.
No.
Oh, okay, okay. Yeah.
No, I'm in Colorado.
Oh, wow.
It's
Okay, got
cheaper
it. Got it.
here,
Well, that's
although it's
because you
getting more
just keep
expensive.
hanging out with us, so it's always getting confusing, and you
I
just think you're
know.
one of us.
I'm
I've got
everywhere.
Tony.
Yeah, that's funny.
Um,
Okay. Yeah.
for any of the slides, the LLC or the S or the C corp, do the tax the application of the tax codes change if you're single or married or any of that?
S corps, not really. I mean, you can have it gets you more advantages because you can have spousal employment if you have
Yeah.
an S corporation. LLCs, you can also put your spouse onto solo 401k. And
Mhm.
then sole prop, no difference there. So, and then C corp, doesn't matter if you're married or not. It's its own standalone entity.
Yeah. Okay.
Yeah. Uh-huh. Yeah. Yeah, but I'd say yeah. Yeah, if your business, Leela, is gonna do $70,000 net income. Oh, if you're in Colorado, I mean, $50,000 net income, S
Mhm.
corp would be good for you. Yeah, because you don't have the $800 fee. Nice. Cool. And then, all right, got a last question before we move on. Kauai, what is high income California? Actually, I think I don't know. That's a subjective answer.
I've always thought that anything above 100 or 120 is
Yeah.
high
I
income.
think it's skewed. I saw some
Yeah.
report recently. It was like if you want to buy a house in like San Mateo County or something, you had to make like five hundred
200K or
forty
something.
thousand dollars or something. I was just like, dear God.
Yeah.
That's terrible. Yeah, because I think also like a couple of years ago, I think I saw that the poverty in the Bay Area was $144,000 for a family
Oh
of
yeah.
like
It's crazy.
husband, wife, and two kids. I was like, dear God. So yeah, Kawhi, to answer your question, I don't know what high income is in California. I just know we got bills to pay and keep the mission going. Great. All right, cool. So we have the next section here. So this is probably a lot more applicable to the so I made this section here for the W2 people. So W2 folks, this is your pay to play strategies. It's not the best. These are if you had to rank these from like S, A, B, C, D, E, F, these are like C tier strategies. A tier being real estate. Real estate is the best investment for tax purposes, in my personal opinion, just because of the amount of depreciation deductions you can get, also appreciating asset, and also debt pay down. So, if you can't score it right away, let's talk about what you can do as W2 to save money on taxes. So the first one here are investment tax credits. So investment tax credits, they will be good. The solar versions are going to be good until the end of this year. However, renewable energy credits are still great. They're all falling under the investment tax credit space. And these are more gated type of strategies to have out there. They do have like some income limits, not income limits, but it has a like a liquidity barrier. So how these deals generally work is that you have like a minimum investment's usually about 100,000 bucks. So it's $100,000 investment. Then you're going to partner up with the developer. They're going to take your $100,000, go to the bank, leverage that out, say into $250,000. So now they're going to put on a solar project onto like a hotel, a business, a school, hockey arena, whatever you name it. Then what do you get for putting out $100,000? You'll get a 30% tax credit. So on a quarter million project, you're going to get $75,000 as a tax credit. Then you'll also get depreciation on the quarter million. So quarter million, say that's 30%. So that's 70, almost, let's cheat and say 33. So that's 25,000. So then you're going to get the full $100,000 back in year one. And then on top of it, years two, three, four, you'll also get an income stream and you might get some more depreciation along the way too, depending on what the project does. So a lot of like high income earners, this is a way to reduce your W2 income because you're buying depreciation and buying tax credits all in one shot. So all the deals they vary. I wonder if actually let me cheat and see if I can let me see if I can go find a find one to show you guys. Let me see here. Because this might be so then you can just see what a real live example of this actually looks like. Solar. No promises if I can find this in time. I probably should have taken a screenshot, but let me see if this one counts here. This one, solar
It almost
income.
looks like the Snoopy. Looks like
Oh,
the
yeah.
the doghouse from Snoopy. The solar
Okay. And
panels.
I don't think my dude's name is in this thing. I'm gonna delete that just in case. I don't think he would care, but I just want to be mindful of his name. Okay, great. Okay, so let me show you here an actual like real live example of this solar looks like. Can you guys see the spreadsheet portion okay? Okay.
Yes, but kind of tiny.
Okay.
If you could
Sounds good.
whittle. Yeah, there we go.
All right. Let me see if I can break this down here. Da, da, da. All right. So state taxes, federal state tax impact. All right. So here, breaking this one down, it's $197,000 to get into this project. And then from this project, it's going to yield $258,000 in total tax benefit, $327,000 the first year, and then over time to over the next, what, 6 years? Yeah, 6 years. The total is 258,000. So the net benefit of this is 61,000. So that's about 31%. And then where does this actually break down of the 327? So if I break down the $327,000, it's technically $191,000 of a tax credit. And then from there, the rest is depreciation savings.
No, thank you.
And
No, thank
then
you.
the same would be the state. Would you get a little bit of a state savings? It's barely anything, but just because states generally don't recognize bonus depreciation. So in this example here, yeah, total state, fed and state impact 327 the first year. But subtracting out returns, it's about 61%, a $61,000 return. So this is like pay to play strategy. Obviously, it's like we're talking about $200,000 here. We gotta be realistic. If you have $200,000, you probably should go buy real estate. That's why I say this is like a class like C type of project to do. But if you want to diversify and you don't want to be all in real estate, that's fine too. Just give me alternatives. Because sometimes we talk to people and they're not all cool and they're in SARE, like understand real estate. And they're like, what can I do? Usually these are the tech bros that don't want to do real estate. And I'm like, okay, what alternative strategies we can do? So investment tax credits, this is a great strategy to do. The next one is, once again, pay to play. I always say these are more tier C strategies. So how oil and gas works is that you get, say it's $100,000 investment, generally speaking, it is, and you're a credit investor. It's $100,000 out. And then you get a thing called intangible drilling cost, IDCs, the first year. So say that IDC is 80% of the project, you get an $80,000 deduction from your W-2. And then say you're at the 30% tax rate, that would save you about $24,000 in taxes. Now, you put out $100,000 to get a $24,000 tax savings. So that means your real investment is $76,000. So that means that over the years, these projects need to return you at least $76,000 just to break even. That's why I'm like, these are more tier C type of investments, just because it's not, you don't get that big of an ROI. It's going to take anywhere from 4 to 7 years, assuming they actually find oil. Oil prices don't go crazy. So there's a lot of unknowns that you can't control. Once again, if you have $100,000, probably going to be better to get into real estate. So that's this gentle nudge for everyone to get into real estate. But hey, once again, if you don't got time, I understand. You might have kids, you got life events going on, you just want to write $100,000 check. Great. Just go ahead and run it that way. So that's what I would do there for oil and gas. And then Bitcoin mining. This is a new one that just landed on our desk this last year in Q4, actually. I'm still doing the due diligence on it, but the concept here is that just like oil and gas, you spend $100,000 in Bitcoin miners, you get $100,000 depreciation deduction the first year. You can bonus depreciate Section 179, all the equipment. So if you put out $100,000, you'll shave off $100,000 on your W-2. And then from there, what will happen is that the miners will obviously mine Bitcoin back into your wallet. However, issues of this is that you don't know what the price of Bitcoin will be. It's volatile. And then these guys are saying about the machines last about 4 years, but you don't break even until year 2 and year 3. So then I'm like, is it really that good of investment? So I'm still trying to figure out the numbers myself, personally speaking, before recommending it to any type of clients. But this is a strategy that is out there because mining Bitcoin is considered an active activity. Active activity means active losses that will offset your active income. And then let's see, tax loss harvesting. So this is for the W-2 folks. And it's pretty basic at hand, but the advanced version can save you a ton. So tax loss harvesting, what this is essentially is that you're selling your bad positions in stocks, realizing the loss, and then reducing your capital gains. So like usually it's like pruning all your bad stocks at the end of the year and saying, I bought I don't even know what's a bad stock. I'm not a big stock guy. I'm an S&P 500 guy. Say you just bought a really bad stock, and then you want to sell it and you cut your losses. You can realize that loss, and then you can reduce your capital gains from it. Now, the advanced version that our clients use, though, is a lot of like the tech guys who have huge positions. We actually use advanced one called the long short strategy. What this is actually we're creating capital losses on purpose. So we had one guy, he had $1 million portfolio. The company leveraged the $1 million of his portfolio. And then recently, we just got the data. They were able to generate $91,000 of losses on purpose in the short. And then in the long term, they actually grew his portfolio zero point 0.5 basis points. So he had growth on his stocks and he realized a $91,000 loss. The reason why we're grabbing $91,000 of losses is because this dude's in the highest tax bracket in California. So he'll pay 23.8 on federal and he'll pay 13.3 on state. So he's going to save about 36,000 or 36% on that 91,000. And then that got done in 5 months. So in like, I'd say a full year, he's going to expect to get $200,000 of capital losses, which will save him $72,000 in taxes. So this is kind of just like a showcase of like, the more I do this job, I'm always like, damn, the rich get richer. Like, so it's really just figure out how to get rich first, and then you're just in the same brackets as, or the same like club as these guys. So that's advanced tax loss harvesting that W2 people can do. And then, yeah, that's that section on pay to play strategies.
Tony,
I'll just pause here and then we can grab some questions too.
I had a quick question, Tony. In that $90,000 example, I mean, maybe I'm misunderstanding, but isn't it better that he didn't lose that in the first place? Because he saves 36% on that 90, but if he hadn't lost 90 in the first place, then he'd be $90,000 richer.
Oh yeah, so this is like where, oh dude, my head like hurt after I talked to this guy. Like the wealth advisor that administers the strategy. So what happens is, yeah, like that's what I was like thinking in the beginning. I'm like, bro, you just lost 91 grand. Like what? But it's not true because what happens is, so in the short term, they lose 91,000. In the long term, they like actively manage his portfolio because I think the AUM is 2% actually. So what happens is that they'll buy Pepsi, wait for it to drop $5, and then they'll like sell it at $5 of a loss. Then they'll replace that stock with Coca-Cola. And then from Coca-Cola, Coca-Cola over the long will actually like outpace or at least make up that $5. So they avoid wash sale rules. So that's like the first part. The second part is that they're actually like using margin. So they use his existing stock portfolio, pulled margin on it to set up a whole new account to make these losses on purpose. So the true benefit of the strategy is actually just the tax loss harvest. The growing the portfolio part is just to break even though, but he was actually to still go up 0.5, which is like, wow, pretty impressive. But also they charge 2%. So I'm like, damn, like it better be worth it, which it was worth it for him at the end of the day. But yeah, that's kind of like how that strategy works. So like in all, like that 91,000 is almost like made up on purpose.
Thanks, Tony.
Oh yeah, you got it, man. Good question. Let's see here. I'll go over to the parts here on the questions and take it here. All right, so all right, cool. Think about it. See here. Danny's not a member of BTS yet. Okay, sounds good. All right, just jam out to some K-pop, man. There we go. All right, and Leo's got, if I am a surgeon in California with high income, what investment tax credit will be a better play to offset my W-2? What other products are there besides solar and oil? So investment tax credits would be great. So generally speaking, like you would probably want to do a mix of that, investment tax credits and get the depreciation. Then you also want to do a mix of probably like either if they're a spouse, they can do the reps or like an STR loophole.
No spouse.
Yep. Oh, what's that?
Did you say spouse?
Yeah, do they have a partner or anything? Married?
No.
Oh, okay.
Single surgeon in California with high income. She
All right.
has a small portfolio. She's one of my investors as well. And we've been
Mm.
trying to figure out how she can offset her W-2 income because she is getting depreciation from the real estate side, but she can't offset that with her W-2 because she's not a rep and she doesn't have a partner.
Oh, wow.
So we're
Okay.
just trying to figure out what is the best play for her in this point. And I do know about oil and gas, and we have broached that topic before. And then you just mentioned solar as well. So I don't know the risks with solar, but Bitcoin sounds a little bit more risky.
Oh, yeah.
But are they just purely tax credit plays, or do they also have some kind of returns?
Oh, yeah. Great question. Yeah. Yeah, definitely. I think you should probably share that name to Annie and she'll find her a husband and then become reps. But all jokes aside here, so investment tax credits would be great part. The pros cons of investment tax credits, I'd say it's like on a scale like 1 to 10, it's probably like 5, like it's in the middle. The reason why I say that, the pros obviously is the tax credit plus the depreciation. The cons is you're technically supposed to show material participation. So you have to show you did 100 hours working in that. So if they're a surgeon, they may not have an extra 100 hours to spare. So if they have 100 hours, though, it's good. Now, the other bad side, though, of this is that based off the regs of how the IRS reads it, some people say that investment tax credits only offset passive income and the depreciation only offsets passive income. Now, there's the other coin of it, the big company being Marcum, which is a top 10 accounting firm in the US. Their position is also saying it's active, though. So you have two butting heads against this of that. That's why it's in the middle. Like my personal opinion is like, like I lean towards it's more passive, but some people like want to take the position as active and then showcase material participation and run it as a true business, then it would count. So that's like the first one.
How do you show that you have material participation when somebody else is running the portfolio?
Oh yeah. So for investment tax credits specifically, same questions I had too when I like first learned about the deal like years ago. And the big things were essentially so one's the projects being like being developed, you're like doing site visits. You're talking to like the project managers. You're kind of overseeing the financials, seeing the day-to-day parts. And then this part I didn't quite agree on, but that's like the positions that Markham took was saying that you could also do energy conferences to pair it in and then do continuing education. So treating it as like a full business, which I see their angle. I just not that aggressive in how I do things, but that's how they say you can grab material participation with investment tax credits.
Okay.
Mhm. So
And that's 100 hours.
100 hours. Yep. Yep.
Okay.
And it scales pretty large. So yeah, what did we see on that prior example? It was like $197,000 out for 261 grand of benefit. So I mean, you could just double the size of the project. So it scales pretty large depending on your investment size. But that's probably one portion. And then I probably push them into like a short-term rental loophole. That would get pushed in pretty well. Just do like a luxury one. And then the other one is so Bitcoin mining. Yeah, this is really aggressive. I'm not sure if you want to do that. Tax loss harvesting is good. The other part, I'll skip forward here just because this could actually be good to answer your question too. The other part here, let me skip my business section. So going into the charity section, I'm going to just skip forward towards it. That how this taxpayer could, like the surgeon, could save more money is actually through charity. So the first charity is Annie's charity, the college. The kids need money, right? So that's the first charity you can donate towards. But the other part is for your surgeon is using appreciated asset donations. So appreciate asset donations, what these are is you're donating highly appreciated stock, or you're donating like art that's been appraised, or you're donating land, trees, any asset that has risen in value that you can donate at the fair market value, you would do that. So you can usually control these through transactions. So fee simple donations. On a scale of 0 to 10, this is definitely an 11. It's up to your risk tolerance on it. It's super risky, but a lot of affluent clients that we do use it. Trump uses it. So it's in there, but it's another activity that the surgeon could use to reduce their taxable income.
So if you, because there was a charity product where she can contribute $50,000 and then she would get 50% of her AGI as a deduction. So I don't know if you've seen that before.
Yeah. Was that the hearing aid one?
No, this is another one. I don't remember what the exact product was. Maybe it was like some kind of device.
Oh, okay.
Um,
Yeah. So yeah, I've
so
seen
you
different
just don't, you
variations of it.
basically donate the money just to get the AGI back.
Yeah, that's where the subjectiveness of it comes into. So, like from a tax code perspective, it's actually all legal. Now, where it blows up though is that the valuation could be not correct based off what the IRS believes. So, if they think that so it was a 50,000, so it is $50,000 in, generally speaking, it's about a 4 to 5x multiple. So that means she's going to get 200 to $250,000 as a charitable contribution. That can reduce up
Mhm.
to 50% of her adjusted gross income. So if she made $500,000, she could take the full $250,000 in the first year. And then assuming at the highest tax bracket, save $125,000. So you're making 75 grand. So it's a good strategy. Where the IRS will poke holes at it is that they don't believe that the appraisal and the valuation is correct, and that's where your investment is at risk. So it's a high reward
Okay.
strategy. It's not bad. It's not great. It's just really like how aggressive do you want to be in it? That's kind of like my recommendation is like pick your poison, 0 to 10, my friend. Like Vegas, church, which one are you going to? But this is a
Right.
big part of the tax code. I mean, the foundation of it is true.
Okay.
Yep. But yeah, I would pair that in, and then also yeah, other donations if they want to do a donor advised fund, that's also great to have too. So those, I would probably say a mix of those strategies would be good. And then of course, popping it in here for the W-2 people is your good old short-term rental loophole. So anyone on the call that's not familiar with the short-term rental loophole, and then of course it being SARE, this is where you can buy an Airbnb or buy like a property, run it on Airbnb. And then as long as you meet the two prongs of average stay of 7 days or less throughout the whole year, and you have material participation, you can run a cost segregation on it, take a whole bunch of depreciation that you didn't pay for, and reduce your W-2. If Danny's still on the call, that's his go-to move. So if you need questions, ask him on that side.
Well, speaking of the
Um,
STR loophole, because Danny and I were just like having a back and forth in the chat. It's like it's so much freaking work. It's like doing a whole nother business and a whole nother job. So it's like, does it really benefit people for regular W-2s, or like would be like the highest tax bracket folks? Those are really making like the difference, because I don't know how much of it's worth it to almost do another, full-time job doing that.
I
It's
think
so
that's
expensive to set up too and buy.
yeah, I think that one always comes down to your just like similar to the charity thing we're talking about. I think it comes down to your pain tolerance of like how much pain tolerance do you have to make a dollar. So I think for tax wise, if you really don't want to pay taxes and that's what you're left to do, it's probably a good move. If you're phased out and you don't feel like doing it, probably not your cup of tea because you probably won't have the grit to succeed anyways. But that's kind of like my opinions on it. If you can pull it off, definitely pull it off. But I know the world's not perfect. Not everyone has unlimited time to talk to guests. So, but it's good to have. But this is really a ton of our like W-2 folks, they do use the short-term rental loophole, especially since bonus depreciation is back now at 100%. If it stayed at 40% and phased down to 20% this year, it I would say it's probably not worth it. The juice is not worth the squeeze. But now it's back to 100%. It's like, yeah, okay, why not? But yeah, really depends on your pain tolerance for making a dollar these days. I think the older that I have gotten, I don't, my pain tolerance is lower and lower and lower these days. Same with my patience has gone up. I'm just like, dude, it's not worth it. I'm just sit at my home and do nothing. Um, Yeah. And then I think that those are the core ones. I know we're coming up on the hour. I'll just go through the questions real quick here before this. And then yeah, if anyone's got more questions, I'll also scroll through my slides just to bring out the best ones too. The pay to play section was very big for the W2 people, but I didn't realize how many small business owners we would have in here. So I can also talk about that. But I'll wrap up the questions and then we'll go back to the goodies on the slides here quick. Let's see, save me text, should I try and explain more on long short strategies? Yeah, so Kawhi, like explaining more on the long short strategy. Oh goodness. Okay, here it is. So long short strategy, this is specifically a capital gains mitigation strategy. And the original reason why we got access to the strategy was actually from one of our clients. He was selling a $3 million business. So he's exiting his business for 3 million. And he is not gonna pay taxes on it because he was golfing. This is why I say the rich get richer. He was golfing with like a wealth preservation expert, and their wealth advisory firm. And what they do is they purposely generate capital losses to help you exit tax free. Now, besides being just an exit strategy, it's also just a great strategy if you trade stocks. So how it works is that you have I think the minimum is $500,000 these days. So you have to have at least a $500,000 stock portfolio. They'll take your $500,000 and then they'll pull a margin loan on it. Once they pull a margin loan, say they got $300,000 to trade now, they will start trading stocks on in the short. So that's why it's called the short. In the short term, they generate the loss for you. So using my prior examples, like I bought Pepsi stock, I waited like, a month for it to go down $5. Then I'll sell it, grab a $5 loss. Then I'm going to replace it with Coca-Cola because in the long term, I think that Coca-Cola is going to get me $5 more. So their goal is at least to break even so you're not losing money on your margin loan, but also to make you some money. So in our client's example, is that he was able to take $1 million portfolio in 5 months, generate $91,000 in losses, and grew the margin bucket by zero point 0.5 basis points. It's not a ton of money, don't get me wrong. It's like barely anything, but don't get like at gross, they return 2.5 because they take 2% of your AUM. So that's how the long short strategy works. So if you know you have a whole bunch of stocks this year you want to get rid of, you want to do the strategy now because it takes, like what Annie said in the beginning of the call, like tax strategies take time to do. Like they can't just like get all these losses tomorrow. Like they have to spend each month waiting for the stocks to drop, buying, replacing it. So long short is great, especially if you have a lot of cap gains that you want to offset. Cool, Tony. Yeah, STR loophole. So much work. Oh, nice. I see that chat now. STR loopholes. Okay. Great, great. Okay. Kalani. Let's see. Full-time W2 RN and a realtor on the side. Can I call 5 reps for my rental properties? That's a pretty good question, actually. Yeah. So if hopefully I pronounced your name correctly. If not, I apologize. But yeah, if you're a full-time W2 and a realtor on the side, you won't qualify for reps if your properties are long-term or mid-term. The reason why is because real estate professional status requires you to have over 50% of your time, which would disqualify you because you're a full-time W2, and more than 750 hours in the trades or businesses of real estate. So you would not qualify. But if you can turn the properties into a short-term rental loophole now, then you can offset your W2 on that side. So yeah, definitely not like there's ways around it. All right. Nice, nice. All right, Danny's out. All right, cool. Cool, cool. All right. Appreciate stock. Okay, great. And then let's see, call. Let's all right. This is good, good. Can the short-term, Dan says, can the short-term rental loophole be used for highly regulated places like the city? For tax purposes, as long as you meet the average stay of 7 days or less, so total days divided by total stays, and you have material participation, it'll work. But if the city does not give you a permit to operate, you probably can't actually operate, and you don't have the stays to go unless you're going to do some underground stuff. But I would always say it's not worth trying to beat the law. The law is there, and they do crack down. And as like clever as we want to get, the pain's not worth it in the long term, just because the city can just shut you down and then your property could be SOL. So I would always like for tax specifically, I actually always follow what legal says. So like I never say let don't let the tax tail wag the dog. I will let the legal tail wag the tax tail though. Like I'll always follow what legal says first and then my tax will come afterwards. So yeah, I always have like good legal counsel on hand. All right. All right, cool, cool. All right. Loss capped at 3,000. So Vathany? That's a dope name. That's the first one I ever met. Okay. Is loss capped at $3,000 per year. So for stock losses, the loss is capped at $3,000 to offset active income. However, just to clarify, so people don't get confused. So let's just pretend the long short strategy created a $53,000 loss for you. Then you had $60,000 of capital gains. You would only be paying taxes on $7,000 of capital gains. The whole 53 will offset the full 60. Now, let's just pretend you only had $45,000 of capital gains. And then you had $45,000 of capital gains and $53,000 of capital losses. You would offset the full 45,000. That leaves you a piggy bank with $8,000 left. And then you can use $3,000 of that $8,000 to offset your active income. And then the remaining $5,000 will then be carried into your piggy bank into next year. So that's how stock losses apply. So sometimes it gets confused by people, but just to clarify it for folks, I'm sure you knew though. Sometimes people get confused. And then how does the IRS know you are part-time for rep purposes? It's generally under audit. So you claim it and you just got to defend your position. If you don't, if you get audited, you just have to show your hours and do it. Definitely don't want to take a fraudulent position. So yeah, the IRS only knows based off of once you come under audit and you don't have the time log to prove it. Yeah. Oh yeah. Oh yeah. Question for everyone. Yeah. Okay. Yeah. So hopefully, yeah, we're encouraging, reps wise, it's a great strategy for sure. Just have all your ducks in a row. So use apps like Clockify, Reps Tracker, your calendar to prove that you're actually doing and then also like do it lawyer time, like charge by the every 6 minutes. So 0.1, don't do your reps track, don't do your hour tracker to the nearest half an hour or 0.25. Like actually have it do down to the 0.1 is what I recommend. And then follow-up question from earlier, would I still need to track material participation if I do STR, or do I not need it since I'm already a realtor? You always want to track actually. So for whether it's real estate professional status, short-term rental, you want to do the material participation, you want to have your miles, you want to have your travel, you want to have your meals, always document. The burden of proof is always on the taxpayer. So if you don't have the proof, that means you will lose the deduction under audit. So always have proof. It's very annoying. No one likes it, but that's how you're going to prove it all out if anything were to hit the fan.
Can you
right.
prove it through calendars versus a tracker? So can you like print out your calendar for the last few years? Because that's what I've been doing on the calendar. And now I realize maybe I should have used the tracker. But can I essentially print out my calendar to show everything that I've done?
Yeah, if your calendar is like pretty detailed, like if you had like the meetings, so I think the only thing I'm not sure like how wild you get with your calendar, if you actually like put in like let's just say you drove, to the site or to the listing site, and then that was 45 minutes. I'm not sure if you put your commute time in your calendar, but if you do, yeah, that totally works.
No,
Yeah.
I didn't put commute time because
Yeah.
commute time doesn't count anyway, right?
Oh, this is the fun part. So it can. So the general definition of the tax code says that your first stop of business, you cannot count the miles or the time. The so that's your first stop. So you leave your home to the office, you don't count that. You go from the
Right.
office back home, you don't count that. But say you have home to office and then office to Home Depot, you can count that. Home Depot and back to the office, you can count that, but office back to home, you can't count that. Now, the quirk here, and this is very interesting. I actually read this. I was not this smart to think about it myself. I read the Tom Wheelwright's book, Tax-Free Wealth by yeah, Tom Wheelwright. I was gonna say Robert Kiyosaki, that's Rich Dad Poor Dad, but that's his CPA. But he in that book, if I recall right, said that you can say that this is your first stop of business, aka your home office. So then you walk down to the hall, and that's your home office. That's your first stop of business. Now, when you leave your house to go to the client site to go show the home, that first that second trip technically will count as business. So that's from Tom Wheelwright. I was like, oh, interesting. I guess I can see the argument for it. So you could make that argument and count your miles or your time towards that now.
Okay. What is that
Yeah.
book again?
Tax-Free Wealth by Tom Wheelwright. It's a carrot dangling in front of you. I think Leela, like if I know that you actually study the
It's
tax
Lila,
stuff,
by the
you-
way.
Oh, Lila. Oh, so sorry. Oh, Jesus, whole hour.
It's
Lila, my
okay.
bad. Yeah.
No problem.
Yeah, if you like read it, it like gives you the ideas and the concepts, but you might get confused on how to implement it. That's the only quirk I have with the book. Nothing against the book. I love the book, but for the normal consumer, it may not make sense on how you actually implement the strategy, which is to me is annoying because I'm like, bro, just tell me how to do it. That's me though, for that book. So if you read the book, just be in store for that. Yeah.
Thanks, Annie.
Yeah. All right, cool. And then how long can you carry over your bonus depreciation for? It should, so bonus depreciation technically generates losses. Losses carry over indefinitely until the property is sold or you wipe them away.
Okay.
So there's no limitation
Okay.
on losses technically.
I was reading on like 5 years, 10 years, and it just got, and then unlimited. So I got a little confused. So
Oh
if
yeah,
you were
there's
to use,
differences.
let's just say you get 100,000 bonus depreciation, you use 50,000 the first year. The other 50 you can carry it forward indefinitely
Yep, for the properties. Yeah, until
for the property until you sell it or
sell it, or you pass away, and you get the stepped up basis. So one of the two.
okay.
Yep.
So yeah, and I'm thinking for my friend again here is
Mhm.
she has a lot of bonus depreciation. She has about
Oh.
100,000 that she can't use right now.
Oh yeah.
And so she's just kind of carrying forward every single year.
Oh, you'll carry it forward. Yeah, because there comes to a tipping point where after you used all the depreciation, what will happen is that your properties will get more profitable. You'll pay less interest. And then on like paper, you're actually going to become more rich or like more profitable. So you'll start banking into these losses. So like we don't have a ton of older clients, but we do have some. And then like they literally have no depreciation left. And I'm like, because like they've used all the depreciation over the 27 and a half years. And then we started digging into their piggy bank of losses, and like some actually have no losses left because they bought these properties for like $100,000 back in like 1970. So there's like nothing left for us to use. So I'm just like, yeah, you want to pay taxes? You want to buy a property? And they're like, I don't want to deal with the headache of buying a property. I'm 70, dude. I'm like, all right, cool. So we just pay the taxes now. So eventually there comes to this tipping point where you will use all that big piggy bank of losses.
And off of the income that you generate, or can you offset the capital gain when you sell it?
So when you have specifically for properties, when you sell a property and you
Yeah.
are able to unlock all the passive losses you've accumulated over the year to reduce
Yeah.
the capital gain of that property.
Oh, okay, got it.
Yeah, yeah, great questions. Yeah. And then Sandra, we got if you are a rep, I heard you can count STR as your hours. I have both STR, MTR, and LTR. Oh, so this is actually a very interesting thing. We had a debate on this a couple of years ago at the company, and then based on what we found, because for rep, it would be separate from STR hours. That's what our firm position ended up being because STRs were counted as active, but like active business versus real estate professional status. Like this is for like real estate in itself. So we keep it separate. But like for that purpose too, like if it's really a like, do you need it to be an STR if you are a rep though? That's also what we're like telling our clients to like, if you got rep already, you might as well just do LTRs and MTRs for the less headaches of it, unless you love STRs for the return on investment. But then also you have a massive headache. So that's like how we go about it for some of our clients. Cool. Some great questions. I'm going to click on these slides really quick just to see if I missed anything for the W-2 folks or the small business owners that I think that would be like a pretty saucy one to do.
Tony, while you click, can I ask you a
Yeah.
follow-up question?
Oh yeah, hit it.
Yeah, this might be obvious to some, but I don't have my own business yet. But when you talk about S Core 70,000 being a good mark, you're talking about like earning your own money through your own business, right? That $70,000 is not a salary from a company. Like we can't
Yep,
deduct
exactly.
on.
So yep, 70,000 bucks of you owning or not owning, you generating your own income from people from your customers.
Okay, that makes sense.
Yep.
All right, thank you.
Mhm. For sure. Yeah. Yeah, I'm not sure if anyone's got bedtimes, but we'll stay on till we run our questions or I go through these other ones. So let's see here. So I guess the other one, since we got business owners in here, might as well use your vehicles as deductions. So your vehicle is always, there's two ways to write off your vehicle. There's the actual method, and then there's the mileage method. Take the higher of the two and stick with it. Generally speaking, if you drive a lot, the mileage method's probably going to work out better. This year it went up 2.5 cents. So you get it 72.5 cents per mile you drive. So if you compare that and say if you drove 100 miles and you get $72.50 as a deduction versus if I used my Prius, I think that thing it's 50 miles to the gallon. So I'd spend $9 in gas or 72.50 based off the actual. So that's the actual method versus the mileage method. Mileage method would come out better. So that'd be good for all the small business owners here. Always track your mileage. So use an app like MileIQ or pick your poison. Just track it because it'll come down to furnishing that to the IRS. So your vehicles are huge. That's always a big one. I actually had someone, I think I talked to her on like 2 days before end of the tax year, and then they didn't do any tax planning at all. And they're like, "What can I do?" And I was like, "I'm gonna buy a car." And then she bought like a Lexus like GX something, and they got the full write-off for the year. Another dude bought a Toyota Sienna for the fam. That business use. It was in December though, at least. So
Didn't you
December
buy
kind
a
of.
new car yourself?
Oh, of course I did. I don't want to pay taxes. Yeah, I bought a Tesla. Yeah. Yeah. Uh-huh. Yeah. It got hit, so I had to rewrap it. It's no longer green.
Oh,
It's this purple rain color now. Yeah. It's fun, but yeah, it was very annoying once it got hit. I was like,
so
damn.
you don't look like $100 bill rolling around anymore?
Oh nope.
Oh.
I'm just purple rain looking now. So yeah. So yeah, vehicles are
Tony,
really
does,
big. Mhm.
does the car have to be 6,000 pounds?
Oh, so yeah. So going back to 6,000 pounds, I'll go to section 179 deduction. So for vehicles, there's a lot of like if-thens within it. So for vehicles, the thing is for if it's over 6,000 pounds, you can write off the full amount in the first year. So as long as it's all used for business, assuming 100%. So if it's over 6,000 pounds, you can write off the whole thing. However, if it's under 6,000 pounds, say it's just like a 3,000 pound two-door, then you can write off, I
Mhm.
think it's somewhere around $20,000 the first year as bonus depreciation, which is this slide here. So you can write off if it's under 6,000 pounds, it's like 20 some grand the first year that you can write off. So it doesn't always have to be 6,000 pounds. And then the other cool thing is that it can be a used car. It doesn't have to be a new car. And then the other portion, lastly, is you don't have to pay for it all. You can just finance it. I remember when I bought my Prius, I put $1,000 down. Like I just financed the other 35 grand. So you don't, and you can still get the full deduction as long as you finance it. It's fine. So cars is a great way to arbitrage the tax code and delay timing. Yeah. So those are some good. So the vehicle one's good. So I'm gonna click through that one. That's pretty good. And then, oh, for the small business owners in here, your QBI deduction, your qualified business income deduction, this is a 20% deduction on your taxes if you are a sole proprietor, a LLC, or a S corporation. So this does have phase outs though, so you want to be aware of the phase outs. And once you start phasing out, you want to use like more of an advanced strategy. That advanced strategy, it's called the 2 out of 7. So you have to just pay yourself 2 out of 7 of wages to maximize the biggest part. So it's a lot more complex. I'm just like making you guys aware of it. The big thing of like everything tonight is just to drop all these seeds in your head, and then you're like, oh wait, I heard something like that. We should probably like, spur it up and like think about it. So those would be your big ones. We talked about charity. The other one that's kind of fun, for the W-2 people here, is, if you guys have heard of like the Bill and Melinda Gates Foundation, it's Bill Gates's foundation, and these are private family foundations. What these are is essentially it's your own nonprofit, and where you can donate up to your 30% of your adjusted gross income. So let's just say someone in here is $100,000 W-2, and they love clean water, some good cause. Like you want to have clean water for other third world countries. You can donate up to 30% of your income into your own foundation to carry out the mission. So if I make $100,000 as a W-2, then I can put $30,000 into my own private family foundation, and then I'll get a $30,000 charitable contribution on my taxes. And then from there, my foundation now has 30,000 bucks, and then I can use that $30,000 to carry out the mission of the foundation. The quirk though is you do have to donate 5% of the asset value to whatever cause it is outside of just running operations. So this is, once again, indirectly, this is disguised as a business. Technically a nonprofit, but it kind of runs like a business. So another thing for us W-2 folks that are in here. And then real estate, yeah, rep status. We'll just finalize this just for completeness sakes. But yeah, real estate professional status, rep status, just in case, you want to know like technical definitions of it. You may see the term thrown out a lot. The reason why I put a unicorn in here is it is the unicorn status of the tax code, but this is essentially where you have more than 750 hours or more in the trades or businesses of real estate. Those trades or businesses of real estate, I think it's 12 or 13. Generally speaking, it's managing properties, brokering properties, selling properties, development, redevelopment. That's mostly what our clients use. And then you have to have over 50% of your time in those trades or businesses. So that's if you work a day job, and that's full 2,080 hours. And if you're, I remember we had one question, that one person who is a realtor and they spend 2,081 hours, you technically would qualify as real estate professional status. But will the IRS believe you? Probably not, because you probably honestly didn't work 4,000 hours, because that's literally 2 full-time jobs. Don't get me wrong, I've met not crazy. I've met very hardworking people. I was one of those crazy people back in the day, so I take that term back. But yeah, you met very hardworking people who can qualify for this. There has been tax cases where they do win. So think about real estate professional status for you there. And yeah, that's pretty much it. Yeah, a big thing here, just on the recap perspective, is like, what's your strategy? Have some strategy for 2026. Overall, doing something is better than nothing is always what I tell anyone. So it's just like you're working out. It's like, dude, taking some steps is better than 0 steps. Same thing goes for your taxes. Do something versus nothing for you there. And then, yeah, our services, yeah, we do all this: tax planning, strategy, filing preparation, accounting, bookkeeping. And then, yeah, if you want to book a call with us, feel free to there. But yeah, anything else we want to drop in the questions, we can answer here. And then from there, I will let the rest of everyone go to bed. Let's see here. Time Real Rides. Yep. Books. Yeah, man, Hans is good. She's got 2 books too. Yeah, on that side. Annie, I've read those. Yeah. May have gotten
I
a copy from me before.
Well, I
Yeah.
think the first one was a little too easy. The second book is much better, and it's more in alignment with what we do.
Yeah.
But in terms of yeah, and it shows like really good examples. But I really do like the Tom Wheelwright book, but really only for those who enjoy reading the more technical writing,
Yeah. Uh-huh. Yeah. There's like,
more
besides those 2
advanced.
books, I haven't found any that were like worth worth the time that I wanted to read yet. Those 2 I like. I think those are
Yeah.
like 2 good books. That'd be worth your time and money to spend into. I haven't seen anything else, just because like with like the amount of like YouTube University there is out these days, it's like, it's not as needed. But yeah. All right, last questions here. If I own and sell my own property management locally 40 minutes away, I don't have a company, can I? Oh yeah, Johnson. So like if you have, as long as you have a Schedule E and you have a property, you can deduct mileage. Once again, like if you're claiming home office or not, that changes like how much mileage you can take. So you can definitely write off the mileage on it, especially, if you want to be super conservative. If I just want to give you an example here, if you don't want to do like the Tom Wheelwright home office strategy and you just want to say, I want to deduct my mileage for doing the properties, then how it would work is say you have your home, you go 40 minutes away to the first property, that part wouldn't count. But then from that property to go to Home Depot, then that would count. And you can deduct that mileage. So if you want to be conservative, or if you want to be like more aggressive, you can just say, I have a home office, and then that's your first stop of business. So your second stop from your home office to your property, then you can write that off. And then you got a new car. Nice. Congrats, man. What'd you get? Last year, would that help with any deduction if I just have a rental, also have full-time W-2? If you used a car for business or rental purposes, then you can deduct a portion of it. And then Austin, yep. All right. Used car also. What we buying, man? Yeah. What we buying? How much do you have to earn in order to see benefits for the private donation business? So, it's going to cost you about 10,000 bucks in administrative fees. So, what happens is that you now need to file a 990 nonprofit tax return. You have to have payroll, you have to have accounting. So, like, you're going to have $10,000 in administrative fees just to keep that thing going. So, if you just kind of multiply out the tax benefits, let's just say use a rough example, you make 100,000 bucks, you're at the effective tax rate between Fed and state, 25%. That's 25. So if you put $30,000 into it and you save $25,000 or 25% on $30,000, that's $7,500 in tax savings. But it's going to cost you 10 grand to maintain. So not quite. Obviously it scales the higher your income side. Like if I say you make $200,000 and you got the 30% rate now, Fed and state. So you can put 60 grand into this thing times 30%. That's $18,000 in tax savings, $10,000 to keep it running and alive. So you still have $8,000 of true tax savings. So maybe around like 200 grand could be like upwards of worth it. Unless you're like just super passionate about it. You could just quit your whole job and just run this thing, to be honest. So like, let's just say you just don't like your W-2 and you're super passionate about water bottles or I'm gonna take a real example. You're super passionate about like financial literacy. Let's use that one. And you just want to have financial literacy spread out across because you didn't have that as a child. Then what can happen is that your foundation can get all the donations to fund it. You then can take a salary from there, and then the rest of the profits just stay in the business. And you just cut yourself a salary. You can just do that too. So you can see benefits like that too. Really about structuring and how creative you want to get with it. But cool. I think we got every question. Any last minute questions for anything? Or else if you want have anything else, we're good. Yeah, if not, yeah, solid session. Appreciate it, Andy.
Lovely, because I have 8 more minutes until my bedtime. Last one, only if it's a minute. My bedtime is literally in 8 minutes.
Okay, never mind.
If it's just gonna take more than a minute, I know you.
Not important.
But we will pull up that QR code and always can get you to schedule more time with him later. But literally, I do have only 8 minutes. I have an 8:30 bedtime this week. But quick announcements for some of the upcoming events. If you guys do like this webinar of what we're doing about this tax savings, Tony does. We have one every other month. It's similar structure to this, more a lot of these Q&As, and so it's more regular. And then we started a new series about SD IRA. So for those learning about self-directed IRAs, how you can invest using one of these tax strategies, and then because there's actually is really complicated on that. And then I know Lila, you're also doing the capital raising, because I've been learning it's a really great way to tap into capital for investment. So if you guys want to tune into those, we have that next session coming up on, I want to say next either Wednesday or Thursday. We already have the first 2 episodes up because it's broken down into 6-part series on that. So the first 2 episodes already recorded and on our Facebook. So do check our YouTube. So go check that out. And then upcoming live events that we're going to have over the next couple of weeks. End of March, especially if you guys are any folks are in the Bay Area, we are going to do a field trip in Sacramento, about the third week of March. So it'll be like a Friday, Saturday, and Sunday event. We'll get to learn about real estate and mostly really hanging out with each other and learning and trading ideas and strategies on investment. And then April 30th to May 3rd, it's actually our 6-year anniversary. So we're going to be going to Austin, where we really started SARE and everything, where I met Nelson for, I think, the first time. And we're going to be checking out real estate from there, Austin and San Antonio, but this one will be more focused on commercial real estate. So for those who are kind of bored with the LTRs, STRs, we're going to learn more about industrial, office, multifamily a little bit, and but also retail malls. We're going to learn actually how to buy malls. So that should be interesting. And then we have SareCon coming up July 31st in Orange County, near SNA, John Wayne Airport, SNA Airport, so in SoCal. And heads up that early bird tickets will end on February 15th. So if you do want to grab a ticket at early bird pricing, go to sarecon.com, and hopefully I'll get to see you guys there. I do have to say, I've been getting a lot of panic attacks in the last couple of weeks, and I've fully decided that it's going to be my last SareCon, like serious. So I do hope you guys do come and see us in SoCal for one last giant time. All right. But with, I know. Look at Tony's mouth. He's like, "What the fuck do you
Oh
think to
man,
say?"
dude. Now you're just straight up just guilt tripping me to go, bro. Jesus, dude. Yeah.
I can't help it. I literally, it's like 7 months away, but for some reason, it's the anxiety and the panic attacks are already starting, and I'm like, I'm nowhere near the normal time zone. My panic attacks aren't supposed to start until like after March or April, and so I was like,
Oh, one
okay,
last hoorah then. I don't
yeah,
know. That's actually probably the best marketing play. This is like Annie's last one. Like, oh man, that's
yeah.
one for the
I'm
times.
like, dude, I'm not gonna use my mental health for ticket sales. But that's not worth it.
I dig
It's
it.
not worth it. But yeah. And then I think we also there's gonna I don't know if the Linfinity, or we're having an event in someone said February 29th, but there is no February 29th. I think it's March 1st. So if you
Yeah,
guys are in the Bay, we'll be around for that.
end of February, I think that's what he said.
It was, and then there was no February 29th on the calendar, and he was like, YOLO, just kidding, March 1st.
Oh, did he change it again? Okay.
I think. But yeah, for those
I
in the
was
Bay,
just,
please do come out and hang out with us. It's going to be a lot of fun.
or if you're not, fly in.
Oh, like, yeah, you can like probably bum at one of our Sarah friends' homes or something.
I need a
Okay.
bed.
Yes, we've got beds. Come on, we're real estate investors. We've got beds. There's plenty of beds. All right. So, and I did record this session.
You.
So, since you guys RSVP'd, I'll upload these later on in the weekend, and I'll send those out to you guys just to have a copy. All right. Good night, everyone.
Night.
Thank you, Tony,
Appreciate it,
for your
Ann.
Thank
time.
Thanks, Tony.
you.
Thanks,
Good
Annie.
Appreciate
Good
it.
night.
Thank you.
night.
Bye.
Bye-bye.